Welcome to session 4. Today the topic is financial planning. It's a very important topic that is preparing us as we are getting closer to the last step that will be talking about valuation. Here we are connecting ratios, income sheet, balance sheet, all the different elements we have seen so far. So first thing, why should we be doing planning? The main reason that we should be doing planning is that this allows us to prepare for the future. It allows us to understand how the company, how the different aspects that are related to the evolution of the business might be evolving in the future, and what type of aspects or external elements might be influencing in that. We will see that usually when we discuss forecasting and planning for the future, we will be saying that it's more an art than a science. There are many assumptions that we will have to be doing. Also, a lot of people might tell you and might discuss that, come on, why do you do forecast if at the end most of the time they are not correct? Okay, we need them. We need to have a reference. We need to understand what are the trade-offs. There are many aspects that trying to forecast, trying to see what will happen in the future will help us to make better decisions. Or at least to be aware of which decisions we are making and what are we giving up on the way. So, a question that might be already coming up is, how do we do forecast for sales and cost when our products are still being developed? We still don't have the products out there. We will be discussing those different options that we might have on creating this future when the present is still unclear. Our objective for this session is that we are able to, for example, generate a balance sheet, a future balance sheet. And this, the way that we do it, is by understanding what can happen in a month-by-month basis, what type of changes might be occurring. And then the most important thing for us is to also see where do we need maybe this additional external funding. Is it after 6 months? Is it after 1 year? When the project is not able to sustain by itself and needs external funding. So again, what we try to get by doing financial planning is to have this reference to assess the impact, for example, of a drop in sales. Can we survive a drop of 20% in sales during 6 months? Yes, no. Do we need more cash? Do we need to ask for additional funding? We should be able to answer those questions if we have done some planning beforehand. And then the other main objective is that we have a tool to quantify those different decisions and options we have. So what happens if we drop the price of our product, of product A or product B? So maybe we get more sales. How does this impact our operating margins? How long can we stay, for example, not having this additional margin for each of the products that we sell? We need to be able to answer those questions. How long can we maybe also have those additional people in our payroll that maybe they are not, for example, right now being used or being occupied to work in some projects or tasks? How long can we keep them so that the company can survive those periods where there are maybe tensions or problems or the market is not responding? Anyway, so the function of planning is to prepare us for this uncertain future and help to see the impact of our current and future decisions. To get started, let's move into a case. So we are looking here at the case of Fitbit. Some of you might be familiar with this company, maybe other people are not that familiar with it. What we have on our slide here is information coming from MarketWatch of how has the company evolved in the last years. So it's important now that you stop the video here and then you kind of try to make sense of what is happening. Then my suggestion is that you pay attention to those arrows. For example, looking at the relation of which percentage is the cost of goods sold on the total sales and revenues, and you can keep creating those ratios and see what happened from 2012, when the first data that we have comes from, till 2016, and try to understand whether the company has been able to improve their operating margins or actually it has been the opposite. So we will try to at least get an understanding on how has this company been evolving. Then after you've been looking at all those different elements, it's a good moment to start thinking, okay, so what does it look like 2017. Those questions that should be coming out, and we will be discussing them, is what do you think drives sales in this case? What drives the cost of goods and the depreciation? How does selling general administrative expenses evolve and change? Is it depending on the number of units? Is it depending on the price per unit? Is it depending on which terminals, or in this case, which products are they selling more? So all those elements is we need to discuss and clarify. Another thing that we want to pay attention is which expenses are directly related to the volume of sales and which expenses we might have anyway. So now we move on and we see what is happening in 2017. In class, we will spend time discussing what has been happening with Fitbit, as we have also additional information from the company, recent reports, more detailed financial statements that will help us to make sense of why, for example, the company is struggling to achieve their targets, why the operating margins are dropping, and why also the sales are dropping, something that was not expected if we look at 2015 financial statements and forecast. At the end, what we want to answer is how would it be? How is going to evolve Fitbit in 2017 and 2018? The idea is that you are able to prepare this forecast looking at, okay, so I forecast that the sales 2017, we already have covered 2 trimesters, so we are getting closer to probably the second semester of what is 2017, that you are able to forecast what is going to happen the second half of the year, the same for 2018. You will need additional information to do that. You will find resources also in the e-learn space. So in this point, you are getting exposed to all the difficulties that we have when we want to do planning and forecasting. Sales forecasting is difficult. What we do, what we rely on usually is historical data. As you can imagine, this has problems. We are trusting that the cycles will be repeated, that the growth models will be valuable for us to have a good reference. This might not be the case. And this is particularly not the case when it's about new products, when we don't have any market previous sales or other information that we can use. So what we end up doing is sometimes we look at which products we are replacing and then try to guess if we are actually successful in replacing those existing products. Maybe we can get an idea about the sales that we might be getting. Sometimes we also use market reports that show trends. For example, in this case, wearables. Are they increasing? The market looks like that it will double the size, but then as you can imagine, we are missing a lot of information about rivalry. New competitors might come in, our products might not be the number one anymore in the market. So again, it becomes a bit fuzzy, a bit difficult to do this forecast. We have other options. We can use, for example, data about the intentions to purchase. We can have surveys. We can actually observe the actual behavior of customers. We can try to track this behavior, whether it will be more frequent in the future or less frequent. And we can look at this historical evolution. So maybe some semesters is when most of the purchases happen. This is likely to happen again in the following years. So a question that might be coming out here is that when we use all those estimations and survey-based data, a lot of times we are not clear in which cases do intentions convert into purchases and in which cases this doesn't happen. So what we try to do is we try to get the best data possible to make this type of forecast decisions, even if we know that it's likely that we don't perfectly guess the final results, but we try to get as close as possible. Then the following step we do is once we start planning for a future, having a forecast or a range of forecasts, then we try to look at the cash. Cash is number one priority for most of the entrepreneurs. Even if you have a VC on board, even if you have a round of investment that has been recently subscribed, you still need to control cash. So here the main worry is, what are my cash inflows? and what are my cash outflows. And we try to look at this at least every month. Uh, Three types of inflows or outflows. It can be related to the daily operations, it can be related to financing, it can be related to investing. If you remember, this is the cash flow statements that we also were discussing at the beginning of the course. Something that is important for us to also discuss in this context is what is the effect when we have chronic cash shortages. So companies that struggle because there is no cash available, they might have to postpone purchases, they might have to even look or pass some business opportunities that they might be having because they don't have cash available. They cannot make those commitments. At the end, what we want is that we can create this new version of the balance sheet. What we do here is that we keep the same elements, the key aspects that we would be listing in the balance sheet, in assets or liabilities, and then we try to control what type of changes might be happening. Especially just imagine that we are focusing mostly in the asset side. So then we try to look at, okay, for example, let's start with inventory. So which changes do we see in the inventory? So we will be having intakes when we buy new materials, when we pay wages, and then we will be also having outflows. When we sell goods, there will be that cost of the goods will be getting out of our inventory. So what we will see is that every month, if we want, we can do this updated report. Here we have just an example. For me, it's important that you see that the difference is that here we are not working on a yearly basis, we are working on a monthly basis. So it's like that we do a statement for every month. So we close January, we see 1,700. Then we start February with that 1,700 as the starting point, the beginning balance. And we keep doing this every month till we reach at the end of the year. As you can imagine, some of those changes, for example, the cost of goods sold will be then maybe going into the income statement when we put the revenues, and below we will put the aggregated amount that we will have in cost of goods sold. Similar things will happen when we look at the ending balance of the inventory, and then we will be also updating our inventory in our balance sheet. And this will help us to start seeing all those potential changes that are happening. This is a good tool to control the evolution of our company, but it's even a better tool to plan and see what can happen during the year. This will help us to identify where there are moments that we don't have cash. For example, the purchases that we are having or the wages, we will be having to use the cash available to pay for most of those things. The same way that we will be getting new cash if we are selling goods to the customers. So our accounts receivable, they also will be changing amount. Here now it's a moment that we take a break and we will be playing the simulation game. We will be giving it a different edge today. We will be using it to understand growth and how can we grow as a company. But then we will be paying attention at which strategies do I use to grow. So this is similar to the idea we will be discussing what is my option to make the company expand. Do I focus on revenues? Do I focus on profits? Do I focus on controlling salaries or operating margins? You will have to pick a strategy. And then what we will be doing is we will be playing the game till the end of the simulation. Not like last time we used this simulation where we were just focused on the first moments of the game.